Well, good evening, everyone. Welcome to our UC Irvine Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks so much for starting your new year off with us to learn a little bit about home buying. We're excited to bring this content to you. This is a course that we provide 4 times a year through the Alumni Network, and really excited to be able to spend some time with you this evening. I know there's a lot of things you guys could be doing on a Wednesday night like this, but I'm so glad you chose to spend some time with us. This is an interactive class that we teach 4 times a year, like I mentioned. And we just spend some time going through some content, but also answering some questions for you as we go through tonight's presentation. So as we kind of roll through the content, you can ask questions by either using the chat feature or Q&A within Zoom, and I'll be kind of monitoring both windows to answer any questions you do have as we go through tonight's presentation. We've been in partnership with the UC Irvine alumni for probably close to 7 years now, and we actually used to teach classes right there on campus, but then as obviously the world has changed, we've kind of gone to more of a virtual platform with Zoom. Allows us to obviously be able to connect with more alum in the community all across the country. And so this is primarily a class that we have kind of based on California home buying trends and analysis, but ultimately this is a course that we provide to alum all across the country. American Pacific Mortgage is the organization I work for. Again, my name is Jason Maida. I'm your presenter this evening. So I also work one-on-one with you in building your home buying plan for home ownership. And we specialize in first-time buyer programs, a lot of which are provided here right in California. So that's kind of what a lot of our knowledge base is in first-time buyer programs. And our relationships with clients generally get started in this type of setting. So we're more of in a classroom setting. And then eventually we kind of work together in a one-on-one format to design a home buying plan for you. So as you decide to go and take the next steps towards home ownership, we'll provide you all the tools and resources that you need to do that. All right. So you're going to learn some concepts today in class that you can take with you as you're kind of figuring out, what does this financial decision look like for me? And kind of, is this something I want to put on my radar for this year as a 2026 goal, or is it something I'm planning for the next couple of years? But ultimately, we hope that you'll provide yourself with a couple key takeaways that can help you make a really great financial decision. Our talking points tonight will include looking at some market data, including interest rates and housing data. We'll also walk through a rent versus buying calculator, spend some time talking a little bit about credit and how to maybe help build up your credit score, maybe just find some areas of opportunity within credit, talk about loan programs that are available to you, probably some of the terminology that you've heard in the past, but like kind of understanding more of the guidelines around these programs. We'll look at savings for home ownership, which can be a challenge for some of us. What are the minimum down payment requirements, but how much do I need to have available to me to be able to provide for my down payment for my home purchase? What are some of the first-time homebuyer programs look like for me? Is there some assistance resources that I can tap into in my local market? We'll go through the home buying process, which will include, where do I go from here after attending tonight's class? So I may say, hey, Jason, I really want to learn more about my home buying plan for home ownership. We'll walk you through the workflow to go from, hey, I've attended a class, let's do a consultation, let's build a plan, and let's go out and find a home that works for me and was within my budget for myself. And then finally, we'll talk a little bit about what's our consultative process look like for you, okay? So that's kind of what our plan is for tonight. I would encourage you again, if you have questions, just pop those in the chat or the Q&A. I'll be kind of checking those out. We are also recording tonight's class as well, too. So if you have to step away from your computer, we will have this up on our YouTube channel as well tomorrow. You can also see some of our other classes that we've taught in the past, all up on our YouTube channel. Those are all available to you as well. Okay, so let's go ahead and start with our class. And we always like to go launch into class by talking about does buying really make sense for me? It's obviously a big financial investment. It's a big decision that you're going to make. And I think as you're comparing your budget of renting and just kind of really paying someone else's mortgage versus what it looks like to having your own mortgage and having a working asset for yourself, think about some of the benefits that come along with home ownership, like the benefits of stability in my housing payment. Now, home prices are expensive. We understand that, but you can kind of control your budget a little bit more with home ownership versus as a renter, you don't have that luxury, right? Clients that are buying in today's market, while interest rates are coming down, they're still at elevated levels, but owners of homes will have the opportunity to refinance their homes at some point, save money, improve their budget over time, and you can do that as a homeowner. This also is an asset that can grow over time. So as my home goes up in value, as I pay down my mortgage, I create more home equity for myself. And that is a working asset for myself. For some homeowners today, it really has the opportunity to create generational wealth for their families. And there are some tax benefits that come along with owning a home, like potential tax benefits, interest deductions in those tax benefits, but also when you make upgrades that are energy efficient, those also can create tax benefits for yourself as well. So, when I think about my budget for home ownership and maybe I'm paying $3,500 a month in rent, when you translate that into ownership, that might not look the same from a budget perspective. To help us illustrate that point, I wanted to share with our class one of our calculators that we kind of walk our clients through in our consultations. It's a rent versus buying calculator to help you understand, what does that comparison look like? So when I add in the elements of appreciation and tax benefits, what does the upside look like for me in home ownership? So here's this calculator. And by the way, we're going to pass along these links to you after tonight's class. There's also some other cool features of our calculators, things like affordability, buying down an interest rate, what's my monthly payment going to be, refinance calculators. So you might want to check those out on your free time too. Those are super helpful for you as either a first-time buyer, second-time buyer, or even someone that's an existing homeowner. So if we look at our calculator, and we just kind of put a what if scenario in there as a $650,000 price of a home, but the minimum down payment for a $650,000 first-time home buyer is 3% of the purchase price. So we'll use that as kind of our benchmark for now. We have a loan amount, which would be 97% of that purchase price. Average interest rate for that level of down payment at 6.1%, a 30-year fixed mortgage. Assumption that we're going to buy, let's just say January, just for our conversation tonight. We have private mortgage insurance that comes into play when we put less than 20% down to purchase a home. We have a special section of tonight's class that we'll spend some time looking at mortgage insurance. There's a lot of misconceptions around that. We factor in homeowners insurance costs, which for those of you that are considering buying in California, those costs or premiums can vary based upon the location of the property, potential fire hazards that exist. Property taxes on average, we generally use 1.2 to 1.25% of the assessed value as the tax rate. If you're considering buying a condominium, maybe a townhouse, then we're going to factor in HOA expenses. And then this is where it gets a little bit more interesting for us as future buyers is we want to factor in like what tax bracket am I in? Because ultimately that can create that potential tax deduction for yourself. But then we also want to look at how much cost am I going to have to invest in maintenance for my home, right? So today I probably just call my landlord and say, I don't have AC, something's wrong, right? Well, as a homeowner, we obviously got to make those repairs ourselves. Selling costs of my home. So eventually maybe I'll sell my home at some point in time. We also factor the appreciation of my home. So how much is my home going to go up in value each year? And then we compare that against someone that's renting. And then so for this scenario, we put a rental rate of $3,000 per month. And then renter's insurance costs that go in my current expenses as a renter. And then the potential increases in my rent. And we put in 2% uptick in rent every year. And that's probably pretty conservative. So what our calculator tells us is that, first of all, it gives us an analysis of what's the break-even point of being ahead of owning versus renting. Well, our break-even point right now is 3 years. So what that means is that the investments I have to make in home ownership versus renting, it's going to take me 3 years to break even when I factor into the appreciation calculation, tax benefits that come along with home ownership. I have a 3-year break-even point. We generally want that break even to be about 4 years. That feels pretty good because that means we're probably buying pretty smart relative to our cost of rent today. But where I think it gets even more exciting for potential buyers is when we span out, let's say 10 years, well, then we have an asset that's really working for us. After 10 years, the gain opportunity is $150,000 of owning versus renting. That's really the big picture opportunity for us. Now, maybe we don't plan on being there for 10 years. Maybe it's going to be less. Maybe it's, let's say, 7 years, right? Well, that's still a $77,000 opportunity for us. So when we think about home ownership, and what I would kind of encourage our class to kind of think is that, even though I'm paying $3,000 in rent, that doesn't necessarily match up to where I want to maybe target my home ownership budget. Now, we certainly want to make sure that we design an option that fits for you and your goals financially on a monthly basis. And, we want your expenses to be in line with what your income is at. But ultimately, I think it's encouraging or important, I should say, for you to know that you're going to have elements of ownership. They're going to really make up an asset that's going to be working for you on an annual basis, right? So that's our rent versus buying calculator. I would encourage you to check that out in your free time. I think it's a great way of kind of getting, a sense of like, what does this need to look like for me in home ownership? Now, the housing market will also play a role on when I decide to dive in and really start checking out homes. Now, I think there's some favorable indications in the market. You can see, prices kind of coming down a little bit. If we were just take to spotlight LA housing, for example, we're seeing the median price come down a little bit. So that's a good thing. Some of that's just seasonality in the markets. Usually in the winter months, early part of the new year, we see kind of the slowdown. After the Super Bowl weekend, we see kind of an uptick in buyer activity, which is just what we've seen historically in the market. But I will say this year seems to be a little bit different when we think about buyer activity. I was just telling someone in a consultation just a little while ago, we're about 40 to 50% an increase year over year in same time January activity of buyers versus last year. I think that's a lot of attributed to what we're seeing with interest rate activity right now. Obviously, interest rates are lower than they were last year. In fact, I think we hit just about a 2-year low in interest rates just recently. We've kind of upticked since then. But ultimately, I think more buyers are trying to beat the spring rush. So generally, when we get to the spring buying season, we'll see more activity in the market, possibly more inventory out in the market as well, too. But this number has really inflated in LA, the LA housing market. To see the median days on market be 60 days, that's a big number than what we've seen in the past. I wouldn't say LA or Orange County housing market is a buyer's market yet, but there's a lot of key indicators that would lend it to be that it is switching from a seller to a buyer's market. So one of the quotes that I've given in past workshops is, we're seeing about 40 to 45% of all transactions having some type of seller concession involved with them, meaning the seller is conceding some type of credit to the buyer for their closing costs and their prepaid items. So that's almost half of transactions being done right now. Some of that is attributed to inspections that are coming back and things of that nature. But ultimately, that is showing us that sellers are a little bit more, I wouldn't say desperate, but in need to make things work on a particular transaction. Well, what do we see for 2026 from a forecast perspective? A lot of what we're going to see is a little bit of a reset in the market. Home buying might become a little bit more affordable, especially with interest rates, starting to slow down or go down a little bit. We may see interest rates tick down to maybe the mid fives by the end of 2026. Price growth is expected to be a little bit modest. We're not going to see really any wild swings in appreciation this year. So, but that is a really kind of a moving target. And it really depends on what part of the country you're in. Obviously, some parts of the country appreciate more than others. Inventory will improve slightly in 2026. Home builders are trying to make up the gap for what resale doesn't provide to buyers right now. So many buyers are intrigued by what new home sales have to offer, whether that's the shiny brand new home or the incentives that builders are providing. So that's certainly in the market. But, the trade-off with buying new construction is, you are taking a little bit of a gamble. Because you do have a certain price and you're expecting that price to be as such with a new home, but you also have, a lot of like startup costs, whether that's putting in your front yard or window coverings in a new home. And there is generally a little bit more expenses involved with new construction, like special interest taxes or HOA fees that come along with new home construction. But it is certainly an option for buyers in today's market. This is a look at what the housing forecast looks like more from a numerical perspective. You can see kind of a slight uptick in resale home purchase price, which is it reflects a 2% increase in price or sales, I should say. And you can see a 3.6% increase in median price. Affordability index improving slightly, all attributed to, a downward trend in interest rates. So, this is a far cry from what we've seen in interest rates over the last, I'd say 2 years, because, back in, you guys can see this by this graph here, we were almost touching down on 8% rates back in October of 2023. Just a really massive increase in interest rates. Now they've come down obviously since that high point, and just about a week and a half ago, we did see interest rates tick down to the lowest levels in 2 years. A lot of that is just because of what's being communicated in the media from the administration. That kind of moves the markets. We saw a little bit of that today, with some of the announcements of no tariffs on Europe. So you saw mortgage interest rates improve a little bit. You also saw the Dow Jones, I think, lifted up to 600 points today. So those are kind of the movements in the market that we're watching, obviously, as a mortgage advisor for our clients. But these interest rates will trend lower. It's not a really an if situation. It's more of a when type of thing. But you can see these movements in the market. That's represented by this blue line here. And then you can see the 15-year below that. So 15 years not going to provide you a lot of rate relief. Certainly, it is lower, but obviously with a 15-year compared to a 30-year, you do have a much higher overall payment. And then below that, you can see just a longer look at interest rates and kind of see where they've been over time. I think the thing I like to share with our first-time buyer class is that, the return of the pandemic rates of 2.5% are not likely at all. I mean, when we think about average interest rates over time, usually we see an average interest rate in the 4.75 to 5% range. That's kind of typical in a normalized market. Now, interest rates are not the same for everyone. When we think about mortgage financing, there's credit score and eligibility that makes up an interest rate. So generally, if I have a higher score of 760 or better, I'm going to have the best available interest rate. Loan program, how much I'm going to finance, what my down payment looks like. One of the decisions you have as a buyer, which in today's market doesn't make sense to invest in, but at times you can buy down points to bring down your interest rate and lower your monthly payment. But I mentioned this earlier, the break-even point of buy down points is about 4 years. But for most clients buying in today's market, at least, their refinance decision is probably going to come in a couple years. So it doesn't make a lot of sense to invest money in discount points when we're probably going to have an opportunity to refinance fairly soon. And then the term of my loan can also influence my interest rate. As you just saw on the 15-year versus the 30-year, if I shrink that term down a little bit, that can give me potentially a lower interest rate. As we meet with our clients, we're going to figure out the best solution for them. So we're going to design some customized options for them and kind of match up to the best possible product. Now, as you saw in the characteristics that make up interest rate, credit is one of those things. So in this part of tonight's class, I want to walk you through the credit model from mortgage, because that is where you're going to understand how the mortgage score is influenced. Now, there are 3 different models to credit scoring. There's the credit card model, which is for the consumer kind of monitoring and credit card applications. There's auto financing, so if we're going to go buy a car. And then there's mortgage financing for any type of home financing that you're doing. So we always take the mortgage financing model when it comes to reviewing credit. Every loan product that's offered by a lender does have a minimum credit score. And so you can see those here. Now, Fannie Mae is doing away with a minimum credit score on conventional loans. So we'll do some updates to our slides here, but there still is kind of an overall risk assessment that is attached to a Fannie Mae loan product. Now, elements in a credit report that are kind of derogatory things like a delinquent credit, major inquiries on your credit, opening up new accounts or a significant amount of accounts, those can all have a little bit of a drag on the credit score, especially if all of those events happen in the most recent 12 to 24 months, okay? And we'll talk more about that as we kind of go through our credit segment. In lending, we always take a look at the middle credit score of all 3 bureaus reported out. So as you guys know, there's 3 credit agencies. There's TransUnion, Experian, and Equifax. They all give us a different score because they have a different risk model attached to each one of those agencies. But we take the middle score of all 3 agencies. So if my highest score is 760, my middle score is 740, and let's say my lowest score is 720, we're going to take the 740 credit score to evaluate eligibility for a loan program and an interest rate. It can also impact mortgage insurance. But it's also the lowest middle score between both borrowers. So if you're going to apply with your partner and your partner's middle score is 700, well, that 700 score would be what we would use for qualifying purposes. And again, drive the product selection, interest rate, and mortgage insurance. Okay. Now, when we have things that are on our credit report that are maybe derogatory items, the impact to your credit score might be in the most recent 12 to 24 months, but how long they'll stay with you on your credit report is shown on this matrix here. So this matrix shows, hey, if I had a late payment on my student loan back in 2025, it's impacting my score, but it's probably going to be on my credit report at least till 2032. Okay. So that's just something to keep in mind as you're maybe trying to manage through any type of challenges that are on your credit report. Now, as you get further and further away from that delinquency, then the more kind of organic improvement you're going to see on your credit report or credit score, I should say. This is a model for the mortgage credit score. And so in our class, I like to kind of walk you guys through the different areas here. Maybe it'll kind of trigger for you an area of opportunity in your own credit score. Because at the end of the day, we want to make sure that we maximize credit score, because if we can do that, we improve affordability for you, because now you have a lesser priced financing option for yourself, right? So the first component is length of credit. Now that is taking into consideration how long I've had my credit profile open. So the longer my credit profile has spanned over time, probably the better my credit score is, assuming all of my payments have been made on time. The next part of that is going to be how much credit do I have in use? So am I trying to open up a lot of new accounts? I just mentioned that earlier. Do I have a lender that's doing a lot of hard inquiries on my credit report? If I do that, especially in the most recent 12 to 24 months, I'm probably having a bigger impact on my credit score. Now, when you decide to apply with us and go through our consultative process, we only do a soft credit check for that initial consultation. The reason why we do that is because we want to provide you with all of your options and choices as a buyer, but it doesn't impact your credit score. And that's really important, because many of our first-time buyers are on a pretty long timeline. It's not going to be like going out and buying a house this weekend, right? It might be a year or 2 years down the road, but we want to provide you guidance properly, understand your credit profile so we can match the best product, but not impact your credit score. The other component is utilization of credit. So that's looking at revolving a credit for you. So in this section of your credit model, we're looking at your balances of your credit cards versus your credit limits. Now, if you are running a little bit higher in your credit balances, let's say you're now at 80% utilization, that means I have now 80% of my credit limits tapped into, or let's say I have $10,000 in dollar limits available to me, but I'm at $8,000 in balances. Right now I'm at 80% utilization, so my credit score has probably seen some deterioration. Ideally, we want to be at 10%. So on the other side of the spectrum is about $1,000 in balances. Now, our first action item, if we're trying to whittle down credit, is let's try to get those credit card balances to 50% utilization, and then work towards 30% utilization. And optimal would be to get to 10% or less. That's when you're going to get a higher credit score, the 800 plus credit scores, right? Now, one of the things to help manage down your credit card debt that I found really helpful in kind of coaching clients with credit is that if you look at your credit card statement, there are 2 dates on that statement. There's the due date for your credit card. There's also the billing statement date, which basically a billing statement date represents when your credit card activity closes out. That's also the same date that your credit card issuer sends out all your activity. That's, what your new balance is, were you on time, what's your new credit limit, all that stuff, right? So my tip for our class is that if you can pay down the balance before that billing statement closes out, you're going to kind of catch the bureaus before they report and be able to bring down that balance, improve your utilization, which in turn will improve your credit score, especially as you're getting ready to apply for something. Now, we'll certainly help you through credit as part of our consultation, because it's not just a yes or no type of situation in terms of your qualifying. We're going to customize options for you and talk through areas of opportunity. But if you want to get a jump start on your credit, that's a great way of managing down credit card debt. Now, payment history is the next component. That's pretty self-explanatory. We want to obviously maintain on-time credit. But if you have late payments, they're rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. The more significant or severe of the late payment, the bigger impact I'm going to have to my credit score. Now, appearing on credit reports is student loans, right? And some of you might be in active repayment on your student loans. I know there's a little bit of back and forth with, litigation on student loans and, what's going on with, cancellation of student loan debt. But regardless of the status, unless you have debt either paid off or canceled, we do have to factor in student loans into the equation of qualifying for a home mortgage. And so we want to kind of just walk you through kind of the approach that lenders have to take with student loans, which is if you're on an income-based repayment program right now, that's the payment that we can use for qualifying purposes. So if I have $75,000 worth of debt and my payment's $250 a month, then that's what we'll use for qualifying purposes. Now, alternatively, if you're not in repayment right now, and let's say you're back in school or you're on a forbearance right now because you're still, in relief on those student loans, then for a conventional loan, we have to use 1% of the balances, and then we use that as a payment to budget for qualifying. If we're doing a government insured like an FHA loan, then we use 0.5% of those balances. So that can change the qualifying for a client. So that's one of the things we also talk through in a consultation, is just to better understand where you're landing with your monthly payments. Because, ultimately, unless you have cancellation of student loan debt, we're going to have to pay those payments at some point. So we want to make sure that it is affordable for you to purchase and be able to still afford any type of student loan debt that's out there. All right, I'm going to take a quick pause before we jump into loan programs, but I just want to see any questions from class so far. Okay, and again, you can use the chat feature. You can use Q&A, and then I'll be, like I said, monitoring both windows, and I'm more than happy to answer any questions. We'll also carve out some time a little bit later in tonight's class. Now, the topic we just talked around student loans, that is a direct kind of correlation to underwriting guidelines that are set forth with loan programs that are offered. I want to give you kind of a high level look at loan programs, because you might have heard some of this terminology, but I think it's important to understand like what are some of the little nuances of each of these products, but from a high level perspective. So a conventional loan is Fannie Mae and Freddie Mac. You might have heard some more talk about them in the news. There's a lot of talk about taking them, privatizing, or really kind of dissolving Fannie Mae and Freddie Mac. But a conventional loan does have a 3% minimum down payment for a first time buyer, minimum credit score of 620. And then in high cost of living areas, we can go all the way up to $1,209,750. But that minimum down payment jumps from 3% to 5%. There's a conforming loan limit that's set every year by the agencies like Fannie Mae and Freddie Mac, or FHFA. And so that conforming limit changes every year with the cost of living changes, right? So I think the new conforming limit is like 832. That would be up to a 3% down payment. Now, FHA is a government insured loan. It's a minimum down payment, as you can see, is 3.5% minimum credit score and same maximum loan amount. The loan amount for FHA will vary by county. So depending on where I want to buy in the country and what county that is, then we'll have a set maximum loan amount. Now, FHA is a government insured loan along with the USDA loan, which is just below that. USDA does have a zero down payment option, similar maximum loan amounts, but USDA is designed for clients that want to buy in rural areas, but they have to qualify as a rural area, but they also have to meet certain income limits to qualify within the program. I bring both of these products to your attention because they also have a new, not new, but 4 months ago, there was a residency change in terms of who's eligible. So you do have to be a permanent resident to access those programs, unfortunately. With a conventional loan, you can be a non-permanent resident and still access conventional loans. But unfortunately, with some changes of 4 months ago, you do have to be a permanent resident to access FHA or USDA. The jumbo home loan program is going to be for clients that need a little bit more, kind of financing resources, but it is going to have a trade-off of higher down payment minimums, higher credit score requirements. So it's generally for clients that need to finance more than the $1,209,750 loan amount. And then finally, the VA home loan, that's going to be for our veterans that have eligibility under the VA home loan. It does have a zero down payment option. You can see the minimum credit score on screen, but there really is no maximum loan amount for the VA home loan product. VA has a lot more flexibility in the underwriting guidelines, a little bit more flexibility when it comes to expenses versus income to really support and encourage the veterans towards home ownership. Now, when we think about loan programs, there are factors that go into the loan that make up what we call as mortgage insurance, or that's an element to the mortgage called mortgage insurance. And so we're going to spend some time talking about private mortgage insurance and mortgage insurance premium, which are two different kind of expense structures in financing, depending on what product you elect. So, private mortgage insurance is going to be tied to a conventional loan, so a Fannie Mae, Freddie Mac loan. MIP is tied to an FHA loan. So let's kind of talk about both of those. Private mortgage insurance and MIP essentially insure the lender against default by the buyer. So if the buyer had an economic hardship, was unable to pay their mortgage, the lender does have protection with that mortgage insurance. Now, PMI is provided by private mortgage insurance companies, whereas mortgage insurance premium is provided by government-backed insurance. And so let's look at PMI here, which there's three elements that make up private mortgage insurance, which is going to be down payment, your credit score, and then how much you finance. So that'll give us a premium that a buyer will pay as part of their home financing. Now, one of the important aspects of private mortgage insurance is that when a buyer reaches 20 to 22% equity in their home and has at least 2 years in that original loan, they can apply to have the mortgage insurance canceled. Okay. You can't do that with MIP on an FHA loan. Now, when we look at PMI on a conventional loan, it's not as expensive as you might think. In fact, that was one of the conversations I was just having before tonight's class. I had a client that was really adverse to putting less than 20% down because they thought mortgage insurance would be this massive number. It's not as bad as you might think. So if we were going to finance $700,000, we had a 740 credit score, and we're only putting 3% down, that mortgage insurance is about $209 a month. So it's not as big of a number as you might think. Now, FHA works a little bit different because it does have two forms of mortgage insurance with MIP. There's monthly mortgage insurance, which is 0.55% of my loan amount. And then we take that by 12 months as the cash value of that mortgage insurance. And there's also upfront mortgage insurance, which is 1.75% of the total loan amount. That gets baked into your total amount financed, but it does add an additional layer of expense for the financing. FHA, as I mentioned, does not have a cancellation option with mortgage insurance. So the only way you're really going to get out of mortgage insurance with FHA is to refinance over to the conventional loan. We look at FHA as kind of more of a entry to homeownership option if a client has to go that direction, because FHA does have a lot more flexibility in qualifying, whether it's lower credit scores, maybe challenges with credit. So it does give our clients that access to homeownership, but there is going to be a trade-off in overall expense structure. Here's a look at what those MIP expenses look like. So if we took the same $700,000 loan amount, we had the upfront mortgage insurance, which is pretty sizable. It'd be $12,250 that gets added into the amount financed. And then the monthly MIP is $320 per month. So clearly a pretty big uptick from what we see with the conventional loan. But again, FHA is going to be a lot more flexible when it comes to eligibility for a loan program, because we have that lower credit score, just a little bit more ease to be able to access homeownership. Our goal is to have our clients hopefully qualify for conventional, but FHA is an alternative product for our clients to have that access to homeownership. Now, one of the things we look at in qualifying for financing is take a look at income. We look at income versus expenses. Before we talk about that comparison of income to expenses, I want to give you just a quick checklist, if you will, of some of the documents that are generally required when it comes to qualifying for a mortgage. And I want to walk you through a few different scenarios that come up as questions for me in working with clients as it relates to income or employment. So here's a general documentation list of the things we would generally ask for when it comes to qualifying for your home financing. So these are some of the things that we would ask for in preparing documents to determine eligibility for a loan program. Now, things like W-2s for the last couple of years, recent pay stubs, those are all pretty customary things. If you're self-employed, we will need to see 2 years of tax returns to be able to determine eligibility. And so that's one of the things that we'll look at when it comes to the qualifying for a self-employed individual. Now, in terms of scenarios, this is where I get a lot of questions, which is, when we think about my employment history, for example, let's say I've been on my job less than a year, for example, can I still qualify for a mortgage? And the answer is yes, because what we'd have to do in mortgage financing, we have to put together a 2-year work and or educational history. So as long as we can piece that together, there can be potential qualifying for a mortgage. So even if I just graduated from UCI, let's say in the fall, and I just started my new job here in 2026, then I could still be potentially eligible because I can put together my educational history along with my new work and use that to qualify for my 2-year work history. Now, where it may be challenging in a 2-year rule for income qualifying is if I'm in a compensation package that has variable components to it. Let's say I get bonuses or I get overtime, stuff like that. In that case, we do have to show, if you want to use those variable sources, we have to show that you've been on your job 2 years in order to count those into the calculations, because we average those variable components over the 2-year period. As I mentioned, for self-employed individuals, we have to see the 2 years of tax history, but we also have to verify that the business has been in effect for at least 2 years to count towards income qualifying. Now, if I have a hourly position, let's say, for example, and I have varying hours, then generally most programs will have us verify, or sorry, I shouldn't say verify, but we will have to verify the employment, but we'll have to average those hours over 2 years to kind of maintain or kind of just establish consistency of how many hours you're working. So if you're in an hourly position and you don't have a set schedule and the hours vary a little bit, then we'll generally average those hours over 2 years to qualify. Now, let's say I'm in a position where I work for multiple employers. I have like one employer that I work 30 hours a week, another employer it's 20 hours a week. Those are technically part-time positions. If I want to count both sources of income, then in that case, I have to show that I've been working on both jobs simultaneously for the last 2 years, right? I also get questions around, other sources of income. Like let's say I currently get rental income today because I rent out a room in my place. Can that transfer over to my new place if my roommate's going to come with me? Well, in most cases, that won't be transferable, especially if you're going to use a first-time buyer program. If we're buying an income-producing property, we might be able to count future rents, but most programs won't allow that. If I have a spouse or a partner that's not going to be part of my financing application, but they do contribute to the household, I can't count their income towards qualifying unless they plan on being on the application for the loan. All right, so those are a few scenarios that we come up with when it comes to income and having discussions with clients around eligibility. Now, we also look at income versus expenses, and we call this calculation debt to income ratio. It looks at your pre-tax income versus the reported expenses on your credit report, like let's say credit cards, personal loans, car loans. But we also have to factor in your upcoming housing expense, like the principal and interest of the loan that you're taking out, the property taxes for your new house, the homeowner's insurance. If you're putting less than 20% down, private mortgage insurance, maybe you're going to buy a condo in Irvine and there's, a $500 HOA, that gets factored into the budget as well too. So if we looked at one of our examples on screen, we have a client that's going to spend $2,500 in housing expense. They also have other debts that are $500 a month. So they're paying an outgo of $3,000 in expenses, but they're making $8,500 a month. So a debt to income ratio tells us that 35.3% of their pre-tax income will go out to those expenses. So of course that is a gross figure. So we're looking at the pre-tax income. So it's not necessarily a reflection of, what you're taking home in pay. So when we think about debt to income ratio and qualifying, the maximum we can go is like 50%. Some products limit at 45%. Now, the sweet spot, so to speak, would be like 33 to 36%. I think that's where most first-time buyers especially feel comfortable with their overall payments, would be if they're at 33 to 36%. But we also understand housing can be expensive in certain parts of California. So that's where we'll see some clients go up to higher debt to income ratios. Or maybe there's other sources of income that we can't validate, and maybe the true debt to income ratio is a lot lower. But at the end of the day, the maximum debt to income ratio is usually 45 to 50%. All right, so that's a quick look at debt to income ratio. Now, one of the other elements that makes up kind of a home buying plan or kind of your overall qualifying for home financing is my down payment, right? And we learned today that the minimum down payment, say for example, on a conventional loan is 3%. Well, how do I kind of get myself prepared with that? Like, what are some assets that I can use to purchase my home, right? So, obviously savings accounts can be used, checking accounts, those are all used. But what I would point out to our class is that those assets that are in those accounts have to be seasoned at least 60 days. So we can't, have a random $20,000 deposit come into our account and not understand where that came from, right? So cash can't be used essentially. We have to paper trail every asset that's being used in a home purchase. You can use 401ks, 403bs, brokerage accounts can be used. Now, gift funds are a little bit different. Gift funds do not require a seasoning period. So gift funds are where a family member is basically transferring you funds that are going to be used for your home purchase. There is no seasoning requirement for those funds. Okay. I would encourage you, if you're going to use a brokerage account or a 401k or a 403b, I would talk to a financial advisor before tapping into those assets, because you certainly don't want to create, a tax implication for yourself, or obviously change, what you're seeing as your return in the markets. Now, savings can be one of those things that's a little challenging for our clients, especially as first-time buyers. Maybe we're just trying to get through student loan debt. Maybe we're new in our careers. And so, as we're starting off our journey towards homeownership in a class like this, I think having a plan towards savings is really important. We have countless clients that we've worked with in the past that have kind of applied a very simple approach, like what I'm going to walk you through now, and have made homeownership a reality for them. And the plan looks like this, is that if I take what I'm paying in rent today, and let's say it's $2,000 a month in rent, but I think with my budget for homeownership, it's like $3,500. And that might not be the right number for you depending on what market you're at, but the math is still the same. So if I was paying $2,000 in rent and I think I can afford $3,500, right now I have a $1,500 gap, right? So our savings plan could look like this. Let's say, as I'm working towards homeownership for the next year, I'm paying into my savings account like I'm making the $3,500 mortgage payment. So on the first of the month, pay the landlord the $2,000. I create a discipline or a habit that $1,500 goes right from my check straight to my savings account, right? I just don't even think about it, right? And after 6 months, before I know it, I have $9,000 accrued in that account. By the end of the year, I have $18,000, not including a high yield savings account that might pay you a little bit more in interest. That's where we start building that kind of that resource for homeownership for yourself. And it's a really simple approach, but it does two things. Obviously, we know it's going to grow the savings account, but it also creates that habit discipline so that when you take on that higher expense of a homeownership or a mortgage payment, it's not such a big payment shock for you, right? And you can get there without feeling the burden of a larger payment. Okay, so that's what savings plan could look like for you. Now, in California specifically, there are some phenomenal first-time buyer program resources that are available to you. In fact, last night we taught a class on the Dream for All program with our partners at CalHFA, and you can find that class up on our YouTube channel where we kind of talk through the Dream for All program, which you can see on screen provides up to 20% of your sales price in assistance or $150,000, which is a lottery-based program that is going to open up on February 24th, but you can be pre-approved for that pre-lottery today and get yourself ready for the lottery. If you want to learn a little bit more about that program, you can go to our website at mortgageeducate.com. You'll get those links here later on in tonight's class. But that's a great program that's offered to you as a first-time home buyer. There are some components to that program that are a little bit different than others. One of the borrowers has to be first generation home buyer, which basically means you haven't owned a home in the United States in 7 years and your parents don't currently own a home in the US, or at the time of maybe their passing, they didn't own a home at that time. So that's a program that you can tap into if that's of interest to you. But there's other programs available through CalHFA. And by the way, CalHFA stands for the California Housing Finance Agency. So it's designed to equip low to moderate income households with resources like that. There's the My Home Assistance program that provides up to 3% of your sales price in assistance for a conventional loan, 3.5% for an FHA loan. Those are both deferred payment loans at a 1% simple interest rate. There's also other closing cost assistance you can get access to offered, like the My Access program, the Zip Assistance program. The design of those programs are ultimately to help decrease what your out-of-pocket expense is going to be, because if you were looking at our savings plan, maybe that pushes us out to maybe 3 to 5 years, whereas resources offered through a first-time buyer program might be 1 to 2 years, maybe even sooner. Maybe it's 2 months down the road, right? Now, LA County has programs like the Green Line program that's offered to you as well. That can be an access point for you as well to homeownership that you can tap into as well. We have our Pathway DPA program that's available all across the country. GSFA is another program called the Golden State Finance Authority program that is offered just in California. And then Fannie Mae and Freddie Mac has some special programs for low-income housing buyers. We partner with Fannie Mae on a program called the 1% program, which essentially means if you put down 1%, we will contribute 2% of your sales price, up to $4,500 in assistance. But you do have to be considered a low-income housing buyer, which essentially means that I make less than 80% of the median income. All right, well, I know that's a lot of information. We do have this all recorded, and there's lots of great videos up on our channel that you can check out specifically for some of these programs that if you want to kind of dive a little bit deeper. Here's a kind of a look at CalHFA. If you were looking traditionally at a conventional loan on, say, a $700,000 purchase price, and you were putting 3% down and closing costs to buy a home, I generally recommend clients budget 2 to 3% of their purchase price, or 14 to 21,000, that means a buyer would probably need about $35 to $42,000 out of pocket to purchase, right? Well, with a first-time home buyer program, if I add in, say, a My Home Assistance program, now I have $21,000 in resources to shrink down what I have to pay out of pocket. Maybe I have to put just my closing costs out of pocket, maybe the $14,000 to $21,000. Maybe I have that on hand, and that makes things a little bit more achievable for me. Or maybe I do need more resources for me. And if I tapped into my access as well too, then I have up to almost $40,000 in assistance. So, there's a lot of great resources you can pull from, like CalHFA. There are some eligibility requirements for that. There's a minimum credit score of 640 for the FHA product, 680 for a conventional loan. The income limits for this program are based upon applicant, not household income, like many other first-time buyer programs are. The income limits are based upon 150% of the median income. And a first-time buyer is actually someone that hasn't owned a home as their primary residence in the last 3 years. Now, Dream for All does have the stipulation of a first-generation element to it, but for the core programs with CalHFA, you just have to be a first-time buyer. And it's eligible for any one-unit property, which would be like a single-family home, whether it's resale or new construction, townhouses, condos. Even manufactured homes are eligible, but it has to be on land that is owned. We did put some of the income limits for the Southern California markets on screen here. We'll also pass in the chat the link to the CalHFA income limit screen. So if it's something you're interested in, you can definitely take a look at that. Part of our consultation process is to be able to present this to you if you are eligible. Ironically, we actually got done meeting with one of your fellow UCI alum that's actually under contract for a home in Northern California with the assistance program, and just made things so much more affordable for them. Another big benefit with that program is the interest rate offerings are a little bit lower for a first-time buyer, especially if you're putting less than 20% down to purchase your home. All right. Hopefully you guys are sticking with us. We're almost to the end of class. I haven't got any questions. I'm looking anxiously for a question. But if you do have some, you can just put those in the chat or the Q&A. Our last topic for tonight's class is the workflow of buying a house. This is probably one of our bigger questions that we get. I'll get a text message from a client that's attended a class or a call and say, Jason, I don't know where to start. Where do I go from here, right? So this is the next steps after tonight's class. And we would encourage you to get connected with us for a consultation. That's a free service we provide to design a home buying plan for you. That's a 30-minute session that I do with every every attendee for our classes that want to participate in a consultation for us. And so we just provide a roadmap to homeownership for you. Now, the output of that consultation is, if you so choose to be pre-approved. And the pre-approval gives you a baseline of eligibility. If you want to act on that pre-approval and start shopping, great, you can do that. If it's something you want to just kind of let it sit for a little bit and just want to process things and see what the market does, that's great too. The pre-approval is good for 60 days, but it can be always recertified at any time. That does kind of launch you into home buying if you so choose to. You may just kind of continue searching online, but when the time is right, you might want to connect with a local realtor. We have preferred realtors that we work with all across the country that are in your local markets that we can connect you with whenever that time is right. We encourage you to work with a local realtor that should be an expert in their market. Do some research on those folks that you do work with, because ultimately, they're going to be kind of your eyes and ears as to what's out there in the market. They're going to know what exactly style you're looking for in a home, what's important to you in a particular community. Now, as you get further down the road and you identify a property that you like, you may take a swing at a particular property that you've seen sitting for a while and you want to make an offer. And let's say that offer gets accepted. Well, guess what? You're going to move to step 3. And step 3 is meaning enter escrow. That means you have a ratified contract with the seller. The average timeline to move from accepted offer to getting your keys and start moving in is about 30 days. Now, it can be as short as 14 days, which some of our transactions are that short because of just competitive climate in certain markets. But on average, it's like 30 days. It can be 21 days. Maybe that's kind of skewing more towards the average, but traditionally it has been 30 days. Now, once your offer has been accepted, you're going to get a call from me saying, hey, congratulations, you did it. You have your offer accepted. Let's walk through some next steps. Let's get you scheduled for your follow-up virtual session, which is what I did with our UCI alum here just a couple hours ago. And let's walk through your financing. Let's make sure you understand all of your costs, your interest rate options, strategy on where interest rates are going. Because interest rates do change by the minute throughout the trading day. For example, at 8 a.m. this morning, interest rates were going down a little bit. We had some remarks by the administration. Guess what? Interest rates changed. They've made a reverse course. So those are the nuances in the markets that we're watching for you as your kind of guidance in the home buying process. Now, we'll meet with you for your follow-up consultation, but you're going to have some action items on your side, which will include making an earnest money deposit on your home. We always tell clients to expect that deposit to be somewhere between 1% to 2% of your sales price. Sometimes it can be as high as 3%. It just depends on what your negotiations look like with your seller. Most or not all contracts within California do have an option for a contingency as part of your contract, which basically means you have some protections of your deposit. So meaning your appraisal contingency would essentially mean that your house is going to have to appraise for what the purchase price is for, and there's a timeline to that. There's an inspection contingency to get your house inspected. There's a timeline to that. Your loan contingency to make sure your loan is approved in a sufficient amount of time. So those essentially give you those protections as or security as a buyer that if something just isn't right with this property, you can have a potential exit out of the contract and be able to get a full refund of your deposit. Step 4 is going to be the processing, the underwriting of your loan. That's more of the administrative task of the loan. We're going to be doing things like verifying your employment, verifying the assets you're going to be using, maybe doing some disclosures for a first-time homebuyer program that you're going to be taking advantage of, maybe looking at locking in your interest rate at that point, but we're, again, going to be very strategic and want to time the market with interest rate locks. But we'll get everything submitted to an underwriter at step 4. Underwriter will then complete that review at step 5 and issue a loan approval for you. That will then require you some action items on your side if there's some things that the underwriter wants, maybe some answers to or some follow-up documentation. As we move through this buying process, you receive disclosures as a buyer. You get an initial disclosures just after your follow-up consultation with me. Once we lock in your interest rate, you get another set of disclosures. And then at step 5, you get a final closing disclosure, which essentially as a consumer gives you a 3-day cooling off period before you go to the final stages of closing your home loan. Because at the closing of your loan is when you're going to sign final loan documents. And you'll also be, depositing your final funds that are owed in your transaction. Whether that's, the remaining closing costs, remaining down payment and closing costs, that'll all be part of your final amount. And as your lender, we're going to be wiring in the funds for your financing. All those monies will get collected by what we call an escrow company here in California. And once those monies are accounted for, they record documents with this specific county that you're buying in with the recorder's office to transfer ownership to you, as well as the deed for the loan. We get the feedback that those things have been confirmed. And guess what? Then you become the official owner of the home. That's an exciting day. I love making those calls to say congratulations because it's a huge, huge, huge accomplishment. It's now the next step really is to coordinate with your realtor to get the keys to your house and fire up that moving truck. So big, huge day of celebration for you. Our relationships don't stop with our clients at that point though, because part of our aftercare program, especially in today's market, we're really staying in touch with our clients that have purchased over the last couple of years about interest rate opportunities for refinancing through our Rate Watch program, our HomeBot system tool that'll help you track your home equity and use some calculators to accelerate principal paydowns on your mortgage, and checking at least with our clients every year to see kind of what's happening. Are there things we can do to help provide you more guidance financially? So that's kind of what the buying process looks like for you. Now, if you're thinking about moving forward in the buying process after leaving tonight's class, like I said, I'd love to get connected with you for one of our free consultations. We generally do that all virtually for that 30-minute session, and it does have a get started component to it. You will complete an online application so we can learn a little bit more about you financially. We only do a soft credit check. You'll upload documents, and then you'll use our scheduling system to pick one of the call times or virtual call sessions that works best for your calendar. If you do have, I know we haven't got a lot of questions in tonight's class, but if you do have some follow-up questions from tonight's class, maybe a scenario you want to run by myself or the team, you can always schedule an introductory call. Or if you want to just kind of get to know us a little bit better about, our services, feel free to use the introductory call option as well too. These are the components of a consultation with us, and it looks very similar to the topics you've learned tonight in class. So, budgeting, assistance programs, if applicable for you, the basic framework of your financing, maybe a credit review to identify some opportunities for you. walk you through the buying process again and next steps. So all those important things that you need to know as a buyer. This is a lot different than what you're going to experience with some other lenders in the market. We really consider ourselves the leader in homebuyer education. That's why you're, of course, attending a class like this. So it is certainly different than what you'll experience from most mortgage companies. From a technology perspective, we do embrace technology, whether that's mobile or some of our AI technology that we use to better service our clients, but it does not replace the human touch of a major purchase like this. So whether that's a text from us or a call just to talk to us to really kind of make you feel at ease in your home purchase, or it's just responding to an email, we want to make sure that we don't, overlook that, right? That's a really important part of this process for you as well. Well, as we get towards the end of class, we actually are at the end of class. I want to just make sure that you guys are aware of our UCI discount program. So as part of our alumni network, we do discount our services in providing financing options for you. Of course, you have access to all of our educational courses throughout the year. And we are a trusted resource of the alumni network and have been for years and have countless number of experiences with our clients, a lot of which are shared on our socials and some of our Reddit communities that we see our name pop up in quite a bit throughout the year. We also have other partnerships that we're a part of, we're really proud of. So if you do have friends, family, maybe some coworkers that are part of those partnerships, or just in general want to learn about home ownership, we would encourage them to attend one of our classes. I think this year we'll probably teach over 50 classes throughout the country in different markets all across the country, but love to be able to have anybody that you think would benefit from those classes tap into that. And of course, all the classes, including this one, will be up on our YouTube channel for you to check out as well too. Last thing I want to share with you is my contact information. So feel free to reach out to me if there's anything I can do to help support you. Whether that's a text or call or an email, just please let me know how we can better serve you. And with that said, we are to the end of class. I appreciate you spending some time with me, and I know everybody's kind of held on. We appreciate the opportunity to kind of present this course to you. Any questions from our class today? I'm going to take it that I was very thorough tonight, maybe because I haven't got any questions. But any questions that, okay, so thank you for the no questions. Okay. Okay, awesome. Awesome. All right. No questions there either. Okay, cool. All right. I think we're good. You're very welcome. All right. Well, it was a pleasure providing this to you tonight. I hopefully get a chance to connect with each of you at some point to maybe answer a question or help guide you down that path towards homeownership. We appreciate you allowing us to serve you with some of this content tonight and look forward to seeing you soon. Have a great rest of your evening. Talk to you soon. Good night.